Hey, hi everyone. This is Waso for us again for another weekly webinar and another tip on how we can actually, save in taxes. Today's topic is a particular topic because I have been basically mostly working on helping small business owners on how to pay little or sometimes up to nothing in taxes. But I realized that business owners are also, taxpayer, individual taxpayer, and some high earner income people are also concerned about, even though they actually didn't, incorporate or create any type of business. Yes. So if you just focus on helping small business or business owner on tip on how to save taxes, it would be fair if you don't sometimes think about individual taxpayer. I know some CPA will not work that way because it's a lower ticket business, right? But sometimes if you really want to help, you need to help across the board. And that's the reason why I decided to take this hard task to actually talk about individual tax planning. The reason being is that it's so broad to talk about individual tax planning, and that's the reason why some people, sometimes people don't even mention about, and some taxpayers don't even think that it exists. That's an individual be able to plan and to do some type of planning or structure or strategy to be able to save or to pay less taxes. Yes, it's a really important topic. I'm repeating myself on that. And that's the reason why I decided, okay, I have to do that. Because if I don't, many of my fellow will just try and keep spend the time to imagine. They will skip time to imagine on what to do or what they cannot do, right? Or they will just think about or see, and they will go with the flow. They will go with what they hear from their friends or from their family member, and not what they hear from a tax expert or from somebody who are making a living to actually advise people on how to save taxes using legal, disposition within the tax law. We're not talking about here about evading taxes, about defrauding the government. We're talking about using what is available to you to use. Just that sometimes we just don't know, right? Or we just even see it, but we overlooked it, right? So that's the reason why I decided that today I will do the effort that I can to actually push the most information that I think taxpayers need to know in order to think tax-wise when they are making any type of arrangement for their own life, right? Yes. So without further ado, today's topic is what? It's right here, tax planning. This is tax planning right there. So what to know about tax planning, right? Especially individual tax planning. So what I want you to know over here is that individual tax planning is the art of organizing or structuring your ongoing daily life financially, the way that postpone or avoid you paying taxes. So I'm going to repeat myself again on this. What is the individual tax planning as opposed to business tax planning? The individual tax planning is the art. It's an art, right? Because you have to play with numbers, with expense and income. So it's an art. It's the art of planning or art of organizing or structuring your ongoing daily living financially, the way that it postpones or it avoids you legally paying taxes. So over here, when I'm talking about from that definition, what do we get? We get the ongoing daily living. That means we are not making nothing up here. It's the art of structuring. The first one is actually structuring. It's the art of structuring. Structuring or organizing. Those are the key. What are you organizing? What are you structuring? You are structuring your ongoing. That means something that you always do, but how do you make it? That's strategy to you, that's saving to you at the end of the year. By the way, most of these strategy or structuring organization, it happens toward the year, like during the year. You don't have to wait on January 1st or December 31st or February 15th to say, okay, oh, what can I do to save more taxes? You can do nothing. What you can do at that time will have effect next year. I mean, on February 15th, the next year. So that is what the planning is. Actually, planning is do something that will have an effect on the other day, right? Tomorrow. You are doing something today that will have an effect tomorrow. Anytime you go to your taxpayer and you just tell him, okay, you know what, do something for me. Whatever the taxpayer is doing, there's nothing that called tax planning. He's doing what is called, compliance. They call it compliance basically. That's the word I was looking for. At the end of the year, by February 15, your tax preparer, CPA, is doing compliance to you. He's not doing no tax planning to you at that time. Whatever he can do there, even though there are some limitation or some few tax strategies that you can actually do by February 15, but those are really, really few, right? So at that time, your CPA can just use the numbers that you provide to him to make you being compliant with the government, which is the IRS, right? So yes, we finished with what tax planning is. Now, as a disclaimer over here, this is not a lecture, right? This is not a lecture because all of us are not accountants, right? You guys are not talking to accountant here. You are not in the university, right? You're not in the college. I don't want to go into too much micro details because many people will actually get lost. But I will do my effort to provide as much information that can help you to guide you in the right direction so that you know what to do. That's the point here. So basically, another thing is that all information that I'm providing here are just informative, right? I'm not doing some consulting right now. That means any information that I'm giving you here, you have to give it and use it as being knowledgeable about the tax business, about the tax planning, about how to save. Do not implement it directly. You always have to consult with your CPA, right? When you consult with your CPA, you can actually tell him to do this for you because you know exactly what we are talking about, right? So if it's a consulting, you are in my office now, everything I'm telling you, I can say I'm 100% sure that when you do this, you will get this result 100% because I have your numbers in front of me. Now, I'm giving a general information to everybody, right? But reading those general information, everybody will know where he can find himself inside, right? And what he can take advantage of, right? Okay? So with that said, what do we have to say? What do we have to know when it comes to tax planning, or especially individual tax planning? We have to know that we live in an environment where almost everything we do have tax consequences, right? Almost everything that we do. Almost everything we do has a tax consequence. Let me add some people in the meeting. Okay, not thinking about tax implication when paying for your tuition, for example, right? Or when paying for your health care, right? Or when paying for your new car, or when purchasing a new house, or even when you are actually fixing your house. If you are doing all of those things, you don't think about taxes. You are just throwing money by the window. And that is not all. You see, everything I'm saying here involves spending, right? Paying for tuition, whether it's for yourself or for your children. If you're not thinking about taxes, you just say, okay, my child is in the private school, I have to spend $10,000, or my child is in the college, I have to spend $4,000. If you don't think tax-wise as you are taking that decision to finance your child education, you are just know, it's obvious, 100% sure, you are throwing money in the window, right? The money you are throwing out will have been useful to you, whether to save for future expense, future use for expense, or maybe to help someone, right? Let's say you are losing $2,000 right there in the operation. Wouldn't that more effective if you have given that 2,000 to someone that really needs money because he's not able to eat during the day? Yes. Or wouldn't that more, a good thing to put that money somewhere that you can use tomorrow for other expense? Yes, you will be. That means anytime you are purchasing a car, you purchasing a house, you will be fixing your house. If you don't think that's wise, you lose it, because at the time we're going to refile your taxes, we're going to ask you those questions. Did you purchase a car? That's why I always ask. Did you purchase a house? Did you even repair your house? Did you pay, tuition for your children? That's the interview process. When we ask those questions, is to see if you took the proactive measure to plan when you are doing those expenses. Okay? So that's the point. And doing nothing about the problem is just throwing money out of the throwing money out of the window. So money that will be helpful to people who really need it, right? So the solution is what? The solution is to think tax wise whenever you have a decision to make, a decision especially that involves money, whether it's because you want to save the money or you want to spend the money, right? Whenever you have that decision, okay, I need to save, I'm planning to do this, I'm planning to go to, let's say go on vacation, or I'm planning to buy new thing, I'm planning to buy a new house, change car, I need to save at least 1,000 every month. When you are doing that for yourself, if you don't get a tax professional involved, you are just doing nothing. Of course, you're going to satisfy yourself to realize what you want to realize. Maybe it's a saving for your retirement, maybe it's a new car, maybe it's to send your children to school, maybe it's to finance your health insurance for yourself, for your children. Maybe that involves money. That is an ongoing thing, because you have to do those things, right? If your children are going to college, no matter what you're going to send them to college, whether you borrow money or it's your own money, you are going to send them to college. You don't have no choice unless you leave them staying home, right? Even online school, you still have to pay now, right? So, yes, the solution is think taxes, and that is where tax planning begins. I'm talking about individual taxpayers here. I've always been talking about business owner. Now I'm talking about you, who doesn't have no company. You are just a W-2 worker, and you may be complaining that, oh, I made this money, they cut me this amount, I made 1,000 a week, they cut 2,000 a week on my paycheck, they cut it. You complain about it. But what do you do after you complain? Nothing. You keep complaining. At the end of the year, your tax professional, your tax preparer will tell you, go there, ask them to cut more money if you don't want to pay taxes. That's the easy answer. Most tax professional or taxpayer, not tax professional, but taxpayer. Tax professional, tax expert is different from a taxpayer. A taxpayer will look at your thing. He doesn't give you no advice, right? He just use what you have there, and he tells you the easier thing to do. The easier thing to do is to tell you to go to work, ask them to collect more money. He doesn't ask you to consult, to plan for next year. He should ask you to plan for next year, instead of telling you to go and ask the job to cut 500 more in the paycheck. So that means at the end of the year, you have a good, you can receive the refund. Whether they collect 10,000 during the year or they collect 1,000 during the year, your tax liability doesn't change. That's a misconception. Your tax liability doesn't change. It's what they calculate at the end of the year. It doesn't change. The only thing that changes is what you are going to pay. If your tax liability at the end of the year is 17,000, given the size of your gross income, of your adjusted income, or gross income, let's call it that. Given that size, if your tax bill, your tax liability is 17,000, no matter what, it's still 17,000. But now, what are you going to pay now? That is where the difference comes in, right? If out of the 17,000, the government, your job place, has collected maybe 10,000 during the year, it just means that you only pay 7,000 now. Your tax liability is still 17,000, right? If they were collected $20,000, I have people that they collect $25,000 on the paycheck, yes. And then your tax bill is 17,000. Then they will just give you the difference, 25,000 that they collected from your paycheck, minus 17,000, they will give you the difference. It doesn't mean that your tax liability changes. What you have to play is actually make the tax liability, 17,000, be lower. And that is what 90% of taxpayers fail to do. Let me read this other new participant. Okay? Yes. So that is what you guys need to know. I don't know what the sound is coming from. Okay, you need to mute yourself, please. Okay, thank you. So that said, what do we go by, or what do you picture when you hear about tax planning, especially individual tax planning? The individual tax planning is based on four main pillars, four main categories. This is where you get most of the tax planning or tax saving will fall into these four categories. And those categories are what I put here. The first one is deduction. Okay? There are four main categories where all the tax planning will fall into. The first one is the tax deduction. The second one is the tax credit. The third one is the timing. I will go into some detail of this tax strategy or pilot, tax pilots. The last one is basically what is globally called retirement account. Okay, individual retirement account. So those are the four main categories where any tax strategy will fall into. You have to know exactly, as an individual taxpayer, in each category, what do you use, what do you take advantage of, and everybody can take advantage on every single category of this taxpayer, of this category of tax strategy. Okay, so we're going very quick. We're going to the first one. This is the first one right here. This is the first one. The first one is tax deduction. What do you see inside the tax deduction? Okay, let me stand like this. Okay, I think we got interrupted for 2 seconds, right? So what I was trying to explain here is that you have the four pillars, the four main categories of tax planning. The four main categories of tax planning are tax deduction, right here, the first one. The second one is tax credit. Then you have timing, the timing of the taxes, the timing of the expense, the timing of the income. Now, or the timing of the investment that we are going to make. Now we have the retirement account. Any retirement account that we take, right, you do will be a tax strategy, right? So the first, when you get to the first category here, in the first category we have work-related expense. In the work-related expense, I was explaining that whenever you have a business or you make expenses, obviously you know that you're going to expense or deduct those costs that you spend for to conduct your business, right? But as an employee, there are also expenses that you can take, okay? Even though you're not the owner of the business. I have to mention, I was talking about the moving expense. If you live over here at A, your job is here at B, now you want to move to go here at C, that means you get close, you are closer to your job, right? It's a tax deduction because that expense, the fact that you have to spend money to move, is related to your job. That's a job-related moving expense. Now, I just want to mention that, unfortunately, this moving expense is no longer available to any taxpayer. It's only available to a certain category of taxpayer. So you always need to consult with your tax professional for him to know if you qualify for this moving expense. The new Tax and Job Cut Act has actually get rid of a lot of tax deduction. We have to know that, okay? So I will go through some other ones. So you have what is called home office. Home office, right now with the COVID-19, so many people are working from home, right? When I say moving expense, if your job actually pays you to move, you don't have to deduct that. It's when you spend that money, your job is not giving the weight of it, you take the expense. But now we have home office. The home office or working from home basically means that even before COVID-19, we always have some people who were working from home, right? If you are working from home, like you are conducting a business from home, it's not your own business, it's your company's business. Whatever you are spending money on, especially you spending money on the rents, because it's not your, even if it's your house, you pay mortgage on it. Any expense that are related to your house, you can take deduction on it. If you don't get reimbursed by your company, I want a lot of people to know, if you are working, if you're now working from home because of COVID-19, your company should actually pay you. Whether it's for electricity, it's for, I mean, they should compensate you for working from, because you are using your internet in your house, you are using your light, you are using your phone, you are using the spark that you are using in your house, right? Instead of using your office outside, where at the company, headquarters, you are using your own house. So you should be able to take advantage on that. That's a deduction. Deduction means that before we come up with how much you should pay, you have to reduce that amount on your income. If your income is $70,000 and you assume that all your home office related expense as $5,000 for the whole year, $5,000, that's really nothing. Then you have to deduct 70,000, 5,000 from the 70,000. That means your gross income is like is now 65,000. That is what you need to know about, and home office expense. Okay, so basically, work-related expense means anything that you do that the company normally is supposed to support. If the company doesn't pay you back, then you should basically deduct that. Very few people know, okay? What I have to do is that some of those business-related expense are what is called miscellaneous expense. The miscellaneous expense was expense like your uniform, right? When you work in, that's uniform. If you are a doctor, you're using all these devices that you use to perform your work. If you're using that and you don't get reimbursed, nobody should take advantage of it, except that the new tax law came there and actually canceled all the what is called miscellaneous expense. Miscellaneous expense was expense that you're supposed to claim up to the excess of 2% of your AGI. AGI is your adjusted gross income. That means whenever you spend money on, you calculate 2% of your adjusted gross income. Whatever is above that, you deduct. So now the new tax law, the new 2018 Tax Reform and Job Act basically came there and canceled a lot of business-related expense, because miscellaneous expense was most likely it was more about business-related expense, right? So the new Job Act or the new tax law from 2018 actually reduced the capacity of everybody to take those expenses, but you still have to check with your CPA to see if you qualify, because there's no rules without exception. The exception of people who can actually still take advantage of, they have the people in the army, they have what is called fee-based and government, local and federal government and worker, right? If you're working for the federal or for the local government, yes, you can take them. There are few, at least 4 categories of people who can still take those expenses. So the first thing is to know that those expenses actually exist, right? The second thing is actually check if you are eligible to take them, okay? And I'm gonna put a link during this at the end of the description of this live to show you the list of all of those business-related expense. You will see if you can take that. Now check if you are eligible. You see if you are even if you find yourself on being able to take it. Now, if you find yourself that you are paying yourself uniform because without uniform you can't perform the job. If you find yourself that you are traveling, that you have to spend money because you are having a meeting with the customer. When you have a meeting with the customer on the behalf of the company, you have to spend money, right? So you are spending money. Can you then take that deduction? You need to consult with your taxpayer. First of all, you see that you are spending those type of expense. Now, if you're going to take those expenses or no, consult with your CPA, okay? Now, what else do we have to see? So this was a big thing. This one, work-related expense, was a big thing, okay? And now the next thing is itemized deduction. Itemized deduction is what? There is a type of deduction that falls into what is called itemized deduction. Okay, let me explain globally what is itemized deduction. Is that when you file your taxes, the government will actually allow you to take a certain amount to deduct from your gross income before they figure out how much you have to pay in taxes. That's what is called itemized deduction. Okay, I think it's 12,000. The new tax law, it was below 12,000 until now it's 12,000. Okay, basically, but when can you take that deduction? You take that deduction if you figure out that when you itemize all your expenses, they are higher than the standard deduction. Okay? The itemized deduction is opposed to standard deduction. The government gives you the standard deduction. That means it's $12,000 that you should take. But if you feel like you spend more than what you're supposed to take, you spend more eligible expense that falls into itemized deduction, then you go with itemized deduction. Now, let's go into a couple of items that you can find into itemized deduction. You have what is called deductible taxes, okay? The deductible taxes, the first thing you have to know is that when you do itemized deduction, the new tax law actually puts the maximum of itemized deduction, especially what is called sales tax, or the sales tax. They put it on the cap of $10,000 because when you are itemized deduction, the main thing you need to focus on are most of the time what is called property tax. Okay, you have property tax, you have sales tax, you have income tax, because in your tax, in your W-2, you have what is called, you have a federal, taxes. You also have state tax. That means the government, people call it SALT. Okay, SALT is basically sales tax, income tax, and property tax. Whatever is state-based, the government put it at 10%. Okay, at 10,000. Sorry. So the maximum we can claim is 10,000. So basically, on the itemized deduction, you have what is called real estate tax. Okay, real estate tax is whenever you are paying taxes on the real estate that is not used for business. Whatever tax you pay on it, you take advantage of it. It goes into itemized deduction. You have what is called sales tax. I just said the sales tax is basically whenever you are purchasing any item from the store or online, if you are charged tax, it's called sales tax. You should take it. I used to have customers who will come to my office during the tax preparation with a big box of receipt. They will actually start, opening each receipt. But what we're looking on those receipts is not the amount. It's not how much you spend on grocery store, no, or how much you spend on the car, on the repair of your car. No. What we are looking for over there is basically how much tax were you paying on each of those. Yes. It's what I'm looking for over there is how much tax you were paying. So that is sales tax. The sales tax is part of what is called itemized taxes. And I see people always collecting their receipt because they want to know how much tax they were paying in terms of sales tax. Yes, it's a tax deduction. So you have what is called charitable contribution. Yes, you can take charitable contribution, even though the new tax law puts some type of restriction on it. Yes, it's a deduction. You have to know that it exists. The gambling loss. If you go to the casino and stuff and you have a loss, yes, you can take deduction. But there are some limitations, right? You have to consult. But you have to know that if you go to a casino and you have losses, you lose $1,000. Yes, you can take deduction of it. Of course, you have to consult to see or up to what extent you can take that loss. Okay, most of the time it doesn't go. It's go up to how much you win. Okay, if you win $1,000 at 5 o'clock and at 6 o'clock you lose $5,000, you're not going to take the whole $5,000. You take the loss at the point of what you won first. Okay, but you have to consult with your tax professional before you actually know what you are taking. Okay, I'm just putting out like this everything that is available for you just to know. Okay, so the other thing is what? Home mortgage interest. So what is home mortgage interest? Whether when you purchase the house, you are paying interest on the money that the bank put at your disposal to purchase the house, or maybe you have what is called the loan secured by your house. If you go to the bank, you get some type of loan. That loan is secured by your house. You pay interest on it. Yes, it's deduction. So every loan that is related with your house, okay, you can take deduction on it. So those are basically the deduction that are related to itemized deduction. We still within this category right here, deduction. Okay, we just talk about workload deduction. We talk about itemized deduction. Now we're going to talk about educational expense. Okay, educational deduction. Educational deduction means that the loan interest that you pay during the year basically is deductible. If you have been paying student loan and you don't even give those receipts to your tax professional, you are losing money. That's what we really have to know. Okay, so that's a deduction. What deduction do you take? You take 25 is up to 2,500, or the interest you pay during the tax year. Okay, so one of those. So basically, what else do you have? You have what is called educator expense. Educator expense is basically applied to the people who are involved in, teaching our children. Okay, basically the new tax law focuses on the K-12 teacher, not only teacher. Every personnel who are involved in the training of your children is a staff, is those teacher aides, everybody working within the school. Okay, all those counselors, all the people that you see in this, not only the teacher that is holding, the marker and teach people, everybody who's involved in helping your children to learn new knowledge that will help them tomorrow, they are eligible to take deduction. Okay, the deduction is about everything. It could be the book, it could be the computer, it could be whatever the teacher needs. It could be a software that the teacher needs to use to actually change it, especially now with the COVID-19. I'm pretty sure a lot of teachers are actually experiencing, software or this IT item to actually help the children, the student, to learn the best and faster way with the COVID-19. Those expenses are actually deductible. Of course, they are eligible expense. Of course, you have to consult with your tax professional for him to tell you, but you have to know. That means if you are spending money on those stuff, you have to track. I think a couple of my previous webinar, I'm focusing on tracking your expense. You're not going to go at the December or February 15, February 10 to 5. It's okay. Let me think about how much I spent. I think I spent $200 on the book. What's the name of the book? I don't even remember the name of the book. I spent $2,000 on the software. What's the name of the software? I don't remember. When did you pay by cash or by credit card? I don't remember. You have to track those expenses, okay? Because in terms of audit, when you track, it's to be able to take the real amount. Because when you don't track them, you are making an estimate. When you take an estimate, most of the time you don't remember everything. That's what people don't even realize. Whenever you are making an estimate of your expense, most of the time you underestimate. If you track what you really spend money on, you will see that you spend more than what you think you spend. So the key is to track those expenses because they are actually deductible, right? Yes. So now what we have is what? You have the healthcare deduction. This right here. Healthcare deduction right here. The healthcare deduction is what? It falls into the itemized deduction. I have to mention that, okay? So what do? The money, you may be able to deduct expense you pay the year for medical and dental care for yourself, for your spouse, or for your dependent. It's as simple as that. You may be able to deduct all the expense that you spend on yourself, on your spouse, or on your children for the same year that those expenses occurred, right? You may be able to take those. You just need to consult with your tax professional. Those are a lot of deduction. Basically, as a rule of thumb, you will actually, the tax law will say that can deduct whatever exceed 7.5% of your what is called AGI, adjusted gross income. Okay? Yes. So you can take those expenses. Of course, you have to consult because some expense may be treated differently. Okay? And whenever you spend money because of the health of someone, you have to know that even though you are fixing your house, even though you are, you are actually upgrading your car, or you are, creating what is called a swimming pool in your house. You are putting some type of escalator or elevator in your house. If those expenses are related to a medical condition of yourself, your spouse, or your children, those are eligible expenses. I have someone who spent money on the swimming pool. The swimming pool costs a lot of money, right? But he was able to take deduction. We're talking about maybe $3,000 right here. Because the condition of his wife requires that the person has to be, swimming like most continuously, right? But he was creating the swimming pool because he wanted the swimming pool in his house. But guess what? It took $3,000 of a swimming pool. Okay? So someone else will create some type of elevator in his house. He can justify that the elevator was needed because his child condition doesn't allow him to be able to use the stairs all the time. All the money you spend on it to install the elevator in your house are tax deductible. That means if your gross income was $200,000 and then you spend $50,000 to get us elevator, you can deduct the $50,000, of course, not $50,000, whatever is above 7.5% of your adjusted gross income. We don't even know what your adjusted gross income is because there are so many items that may be involved. But the bottom line is that you will deduct something out of it. Okay? So, yes. So those are the last one that you have within the deduction. Within the deduction. That's why I told you this is a really broad topic. As I will try myself, if I can help my fellow taxpayer to get something out of it. Okay? So the last one is the investment related expense. Okay? What is investment? Investment is basically when you spend money on something and you will sell the same thing. That's investment. The investment, if I purchase this to use, it's not an investment. It's not an investment. The investment is whenever you spend money on something to get what is called return on investment. That's the investment. So if you purchase something, the first big one that many people overlook or not even aware of is what? Is the sales of the house. When you sell your house, the profit on your house, you know that there's a tax deduction on it? No. A lot of people don't know that they can actually take the first $250,000 of the gain from the sales of their house. Okay? They avoid paying taxes on it. You purchase the house for $200,000. You sell the house for $100,000 or $350,000. $350,000. You purchase for $200,000. You sell it for $350,000. Of course, maybe you made some type of adjustment to the house. But the balance is the profit you're making. There is a way that you can actually avoid paying taxes on it. Normally, that profit should be a capital gain. It should be a gain to you. Okay? You should pay taxes on it. But there is a disposition a tax provision that allow you to take up to $250,000. People purchase house for $600,000 and sell them for $800,000, right? So you have to know that there is that disposition. That means if you know that when you are selling your house, it may have an impact. You will have to say, okay, oh, I don't want to sell because I'm not sure about, I want to pay taxes on it. No, you have to know. And before you even sell your house, you have to consult. Anytime you have the big decision to make that involves money, consult with your tax professional, consult with your CPA. That's the reason why every big company that are serious will have a tax department. The tax department doesn't sell nothing. They are there to actually analyze any financial transaction of the company to see where the company will save taxes and advise the CFO on that, advise the CEO on that. Basically, that's it. Because the company will rather keep that money within the company than just throw that money out to the government. Okay? So, yes, you have what is called individual retirement arrangement. The individual retirement arrangement is what? Is that whenever you are paying, okay, whenever you are making those retirement, most of the time they give you deduction on it. Deduction means that when you are paying for your retirement, whatever amount you are paying, whether it's a full amount, it's a partial amount, you can take deduction. That's the reason why your gross income will be different from your taxable income, because you are taking deduction. That's an investment, because you are investing in your retirement, right? And you have what is called capital loss. The capital loss is basically anything that is personal. Anything that is personal. Almost everything you own and use for personal or investment purpose is capital asset. For example, your house, you use your house for personal, for personal use, right? You have personal use like household furnishing. You have stock and bonds held for investment. So basically, if you have too much money and you purchase some stock, right? You keep them, you will sell them. Those are capital assets. Your car is a capital asset. Your house is a capital asset. Anything that is owned by you, not by the company, okay? When you sell them, there is a way to take advantage on the loss that you are making on the sales of that capital asset. That is what they're calling here. Okay? So, yes. What else do we have to talk about? We talk about all deduction. Now we have to talk about the credit. Okay? What do we have in the credit? In the credit, we have also a couple of subcategories within the tax credit. We talk about tax deduction. I have to tell you that everything that we just said for tax deduction is not all. I'm just trying to point out what are, the ones that are more visible, okay? The ones that are more visible to you to take also, because most of the time you are doing it. Most of the time everybody is working. Everybody within Academic Deduction, we explain what we can find within the Academic Deduction. We explain the educational expense, right? We explain that most people have student loan, right? Some people are teachers, right? So there are deductions they can take. We have healthcare deduction, okay? Whenever you are paying, spending money to take care of your family, you can take deduction, right? Okay, now we have tax credit. The difference between a tax deduction and a tax credit lands within the fact that the credit is a dollar-for-dollar tax reduction. The tax deduction will influence the calculation of your taxes because it will lower your taxable income. But the tax credit is actually a dollar-for-dollar reduction of your taxes. That means if your tax is $10,000, if your tax is $9,000, you have a credit of $1,000. Your new tax is $8,000, dollar for dollars. But if you have a deduction of $1,000 and your tax is this amount, it doesn't reduce it to $8,000. it will reduce to something we don't know yet, because we have to go back up here and figure out what was the taxable income that we used to get to this 9,000. Okay? We get that taxable income, we reduce it by 1,000. Okay? We get this taxable income up somewhere here, we reduce it by 1,000 before we come up with the tax. You know, the tax will be different for this 9,000, because whether the taxable income was $20,000 and then we came up with 9,000. If the new taxable income is $19,000, the tax will not be, it won't be 9,000, it will be something below 9,000, right? So it's really important to know about credit, because the credit will reduce your taxes. And in another way, it will increase your refund. If you're supposed to receive a refund of $2,000 and you get a credit of $1,000, your new refund is $3,000 instead, because it's a dollar for dollar. We just saw here that oppositely, if over here you receive the refund, right? But over here you don't receive the refund. You pay. You have to pay 9,000. If you have the same 1,000 credit, you will pay 8,000 instead of 9,000. You see, you have a gain of 1,000 flat. That is the difference between tax deduction and tax credit that we have to know. If you don't know, we don't even know what you're doing. Okay? So one of the first deduction falls the subcategory that falls within the tax credit is what we call family and dependent care credit. Okay? Any credit that's related to your family. And one of the first one is earning income. Your earning income tax credit is related to your family in the sense that the more children you have, the more you are earning income tax credit. They give that money to people who actually, have children. But the people who earn, that means you work. If your income is zero, you don't have any income tax credit, because you have to earn something. They want people to work. Even though if you have one child, you don't have money. Show the government that yes, I have been working, I have 3 children, but I only work for 10,000. The government will give you credit. If you have one child, they will give you credit for the one child. If you have 3 children, they will give you your refund will be more than if you only have 2 children. Okay, so that's what they call family and dependent credit. It could be based on your children or the people who depend on you, basically the people who are your dependent. Okay, and inside you have earning income tax credit, you have child tax dependent care credit. The money you spend to take care of your child because you go to work, because you go to school. If you go to the health care, right, to drop your child there and go to work or go to school, you can take credit on it, right? A direct credit. So you have what is called adoption credit. Same thing. If you adopt a child, you get credit for that. You have what is called child tax credit. The child tax credit is basically, it has nothing to do with your earning income credit. Just because you have that child, they can give you that credit because of that child. If you remove the child, they remove that specific amount of credit. It's none. You can know that amount in your taxes. Okay? So, yeah, credit for elderly and disabled. Yeah, the old people, we also give credit for that. If you're taking care of your grandpa and grandma, they give you credit for that when you file in taxes. So, yes, the first category, that subcategory of tax credit we see is family and dependent credit. Okay, we have income and saving credit. Income and saving credit basically is about your earning income tax credit. I just say that up there. The earning income tax credit is based on the size of the family, but it's also based on the income that you're making. That's the reason why it falls into those 2 categories. The earning income tax credit falls within the family and dependent credit. It also falls within the income credit, income and saving credit. Saving credit just means there's one credit called savers credit. Because you are maintaining a type of retirement account, you may get a credit for that. I didn't say deduction, I said credit. But how many people even take advantage of? Almost nobody, right? Or very few people. Why? Because they don't even know that it exists, right? Yes. So the last thing, not the least, that's not the last, because it's just the one that we're going to talk about now. But we still have more, because even though we spend 4 hours here, we will not go into all the singles, deduction, or credit that are available within the tax law that you can use to pay less taxes. But I'm going to share with you what is called foreign tax credit. Okay, I see a lot of people having business, abroad, right? But how many people take advantage on business that they conduct abroad? Or I have people working for the United States, but they're working abroad, right? How much credit do you take for the taxes? Because I don't know which state, which country you live, you don't pay taxes. Any country here where you live, when you work, you pay taxes on it. So if you are a US citizen, you live in France, you are paying taxes in France, whether you work for the US or you don't work for the US, or you work for a French company, you are paying taxes over there. But guess what? You are a US citizen or you're a resident, you also have to file your US taxes right here. Do you take advantage on the taxes, what is called foreign tax credit, the tax that you pay abroad? No. Most of people just don't. Many people will not even claim the business they're doing over there because they don't want to know that they're making money over there. But it doesn't matter. You will still have to come to the US and file your US taxes here, right? So it's a very broad topic. That topic only is a very big one, okay? I'm just globally, generally telling you that there is an advantage of taking taxes on earning, what is called foreign tax credit, whenever you live out of the US and you're making money, okay? Yes. A credit is what I just told you what a credit is. It reduces directly your taxes, right? Okay, yeah, so the next subcategory here is a homeowner credit. This is a big one. It's over here. This is a big one right here. We talk about income and saving credit. We talk about family dependent credit. But now we're talking about homeowner credit. The homeowner credit, what does that mean? It means that as a not business owner, as a homeowner, okay, there are so many options that you can take credit of. I'm going to share one with you. One is what the government, the IRS, call residential energy efficient property credit. It means anytime you make some type of repair or improvement in your house, that helps to save the environment. That is energy efficient. That means maybe you are using solar panel in your house. Maybe you are using anything that will actually save the environment. I'm not a homeowner. I mean, contractor people will tell you what you can use that will actually help you to pay less electricity, right? Yeah, I know. Because I see those advertising that, okay, if you are paying too much electricity because you stay more in the house, this is how we can help you. And sometimes they will install some type of device in your house that will help you to use less energy. Okay? It doesn't matter whether it's for the phone, internet, or water. Whenever you are using those in your house, it gives you tax credit. If you have to repair your window, you have a window that is broken. If they tell you that if you know that by repairing your window with this type of material, it will give you credit. Of course, you will go with that one, right? It will give you credit. You will go for that one because you are taking double advantage here. Not only taking deduction on the house for the repair, right? The repair you make on the house, if you rent a portion of the house, you can take the deduction of it. But you're now taking a credit on the same expense. You are using the same expense twice. So you have what is called healthcare credit. Okay? What is healthcare credit? We have to know that there's what is called premium tax credit. The premium tax credit, the health coverage tax credit, those are expense, those are credit that the government sometimes will give to people. The government most of the time will provide you with those credits because let's say you purchase a health insurance, right, on the marketplace. At the end of the year, we figure out that no, from the level of your income, you are not supposed to pay that amount. We should give you this credit, right? That's the reason why I always ask people, do you have health insurance? All my customers will know, yes. Was the insurance from your job or you purchased it from the marketplace? Yes, because it's from your job, it's a bonus, the job is helping you, right? It's from the marketplace. Now, how much did you spend on health insurance? Right? How much did you spend on it? Now we will see, according to your level of income, if what you spend was too much for you, given your level of income. That is where the credit comes in. Okay? So you have to know, and you have to have an interview and process with your tax professional when it comes to tax preparation. And during the year, when you think about paying for health insurance for your children, you have to consult to know what will be advantageous to you. Okay? Sometimes it could be not the health insurance, but some type of health saving account that would be more beneficial to you. So just ask your CPA, okay, I'm worrying about my health issue or my mom, my children health issue. I need to do this. What is the best option tax-wise? Because no matter what, you want to take action. You want to do something, right? Yes. So the last one, but not the last one, but what we're going to talk about today, about the tax credit, is the educational credit. Okay? Educational credit, what do you have? We have what is called American Opportunity Credit. A lot of people know that it's up to $2,500 a year, right? They give it's a credit. That means dollar for dollar credit, okay? And they have what is called lifetime learning credit. The only condition is that there are always exceptions to those credits. That's what I want you to know. I want you not to be so, okay, I don't know what I didn't take the credit. If you have a professional tax professional that actually didn't take it and he explained to you, if you give me the explanation, I can say yes, he was right not to take that credit for you. So always consult. I'm giving you what is available. Okay. One of the conditions is that you can only take those American Opportunity Credit only for the first 4 years of your college. But the lifetime learning credit, as the name says, is a lifetime. You can take it anytime. Anytime you spend money to improve yourself, right? There are some conditions. We're not going to go into the condition now. One of the conditions is that you should not be taking that training to change, your field. It should be the training you take to have more experience, to get more knowledge in what you're already doing. There are so many. There are few requirements that you have to, fulfill before you are eligible for it. But you have to know that they exist, right? Yes. About deduction, about education. We talked about education credit, but there is a big one that is actually education deduction. I didn't mention on the deduction, which is actually, sometime I talk about that. I have one full, I think it was 2-hour webinar when I was explaining about the educational deduction. I was talking about the 529 plan. I'm not going to touch 529 plan. Go Google 529 plan. You see how you can take advantage of it. Okay? It's avoid you paying taxes. Okay? So now what's the next one? The timing, right? You have a tax. We talk about the credit. We talk about tax deduction. Now we talk about tax timing. The timing. What does the timing mean? It means that is it better to make this expense today than waiting and make the expense tomorrow? That is what the timing, the timing of the taxes mean. It is the timing of the expense or the timing of the spend of the income, right? So yes, typically it's better to defer taxes whenever you can, right? it's better to defer taxes whenever you can. For example, you can defer income to next year if you believe income will be lower. Okay? If you believe that your income next year will be lower, you can defer your income to the next year. How to defer income is another thing, right? You know how to defer income. It's another topic. You can defer income to next year because this year you want to recognize this income. I just told you the income is whatever source derived. That's his gross income. For example, you want to sell a house this year. You are already in the higher tax bracket. If you sell the tax here, the profit on the sale of the tax will increase your taxes. You will be in the much higher tax bracket. But let's say next year you are planning to take the vacation, you are planning to do this, you won't be available to work. You can actually plan that next year income will be a lot lower. It's better to send that over there because over there you have a lower tax bracket, right? Next year you will have a lower tax bracket. It's better to defer that income. There are so many ways to defer income. On the individual side, on the business side, oh, it's obvious, right? There's so many ways to defer income on the business as a business owner. So I'm saying that on the timing, it's better to defer income to the next year. For example, if you think that next year your income will be lower because you will take advantage on the lower tax bracket next year, on the same place, you can also accelerate deductible expense into the current year, right? To beat the standard deduction. If you have so many expenses, that will be spread into 2 years. If there is a way to accelerate those expenses in the current year, it's better to do that because now you can beat the standard deduction. Remember, standard deduction is $12,000. If you can accelerate expense and put the standard deduction at let's say $20,000, it's better to accelerate this year and take those deductions. This is standard deduction right here, $12,000. If the eligible deduction that you have this year are $10,000, and next year you will have another eligible deduction of $8,000. If there is a way to accelerate this deduction right here, do it, because it brings it to $18,000. And now you beat the standard deduction right here. This is a greater deduction than this one, right? If you don't do it, this year you will take the standard deduction this year, that's $12,000. Next year you will take another standard deduction here, that's $12,000. You are not taking no advantage on all of these deductions right here. Not taking them, okay? So yes, that is what is called the timing. Okay, is it possible to do this investment now, then doing it next year, or doing it after 2 years? That is what the timing is. And most tax strategy also relies on the timing, on the expense of the saving that you're making, okay? But of course, if you think you will be in the higher tax bracket next year, consider taking the opposite approach. If you think you will be in the higher tax bracket, right, do the opposite way. Accelerate the income this year, right? Accelerate the income this year and defer deduction expense to next year. It's just the opposite of what we said here, okay? So I think we're done with the timing. The last one right here is the retirement. So on the retirement side, it basically means that whenever you are thinking about your future, you are saving, you are putting money aside, the government helps you a lot on that. The government will not only deduct it most of the time, the government will give a deduction. The deduction means that it will help you to have a lower tax bracket. I mean, lower tax bracket because it's going to lower your taxable income, right? That's a deduction. But in most cases, you also have credit on that. Yes, you also have receipts over here. There's a credit for maintaining a retirement account. Just that most people don't even know that it exists, right? Yeah, that's globally what you have to say. But for the specific IRA, which is an individual retirement account, you need to know that what you have to save, there is a minimum, there is a limit on what you can actually, put into your retirement account. But last week, I went into, I believe what, last week or 2 weeks from now, a few weeks away, I think I went to the SEP IRA. I went to the SEP IRA. This is also IRA, by the way. This is IRA right here. This is IRA. You see, retirement account, individual retirement account. This IRA. The IRA gives you, I think it's a 6,000. It changes every year, right? Every year it changes. It's 6,000 or 100% of taxable compensation that you receive. That's whether you put 6,000. The maximum is 6,000 or 100% of whatever income you made, right? For example, if you make only 3,000 a year, and what you will put the maximum reward, they want you to put the lower amount, the smaller amount of what you make during the year, and 6,000. If you make only 3,000 a year, or maybe 4,000 a year, the maximum you can put in your retirement account is 4,000. There's no way you're going to put 6,000. By the way, we didn't even work 6,000. How are we going to put 6,000? They don't want you to go get some income someplace and come and put in your retirement account. But we talked about the SEP IRA last week, and we saw how advantageous was it, the SEP IRA. So I didn't want to be that long. I'm exhausted myself. I think it was everything. The key, what do you have? What's the key? What's the takeaway? The key takeaway here is that there are 4 main ways for individual taxpayer to save in taxes. Okay? There are 4 main ways. The first one is tax deduction. The second one is the tax credit. The third one is the timing of the transaction. The last one is the retirement account. Okay? Those are the 4 main pillars where people rely on when they want to do the tax planning. That is where we rely on to conduct the tax planning to you. I'm just giving you the secret, right? So now you just need to know what's available. I have a question to you. I have a question for all of you guys on the Zoom meeting. You know we're on the Facebook, but in the meantime we're in the group, right? We have a group where we conduct meeting every week, and only member of the group have access to that private group. Okay, which of these tax deduction and credit do you usually take? So I want you to just let me know on the comment right here, whether it's on Facebook, within this webinar, on YouTube, when you're going to watch it. What tax deduction or tax credit do you usually take? Let me know in the comment, right? I'm so happy to see that people take the deduction. Okay? The fact that I'm also know that a lot of people don't take it. That's the reason why I'm coming here to share what I know with them. I'm not doing this for money. Now, which one do you didn't know about from this meeting, from this live? Which one didn't know that you just learned about now? Of course, there are also a lot of them that I didn't mention. I have to be honest with you, okay? But at least I mentioned a lot. Which one from everything I was talking today is it that you didn't know about? Let me know on the comment below. So yes, do you guys have a question? Is there any question that somebody may have? Okay, before you prepare your question, and we got finished. Basically, what you have to do is what? Is that I have this program that I have designed specifically to show any individual taxpayer how to conduct his own tax planning. Because everything I'm doing here, if you have all the tools, you do it by yourself because you have all the numbers. Even though when you have to go to the city, you ask all your own information. You have all your information. You know all your plan. You know what you're going to do this year or next year. You know what you want to do for your retirement. You know all the information. So we have this program that can help you to actually do it by yourself. Okay? Conduct your tax planning by yourself and even implement them. Okay? It's better to do it because when you do it, you know what is going on. You can just ask for guidance. Okay? You can ask for guidance. When they say tools mean that when you put X, it show you Y. You put A, it show you B. It show you the if, what if, and it give you the answer. Basically, yes. I decided to share that with taxpayer. That means everybody can actually do his own taxes, right? I mean, not taxes. Tax planning is different from taxes. Okay? Some people do their own taxes, right? But not all the people do the tax planning. People can also do his tax planning, but he's not able to do the tax preparation, right? So saying that I can actually teach you how to do your own tax planning doesn't mean that because you do the tax planning, you can do your tax preparation. It's just that you know exactly how much you will save. You will know what I will tell you if you came to consult me. If you came to have me conducting this tax planning for you, I will tell you those numbers. But if you do it yourself, you will know the same numbers, because you will plug in all your information in there and you will get those results. You know exactly. Now it helps you to manage, the year, because you know what you will be able to save. Yes. So yes, if you are interested, at that time, if you use that, you can actually use it to help your family member, to help your child, your brother and sister, to actually do the same thing. Okay. So yes, if you are interested in getting into that program, you will just type tax planning on the comment, and I will count you among the people I'm going to get access to that program. Okay? Yes, that was the only thing I want to add to you, and you will avoid you to pay 1,000, 2,000, or even 10,000. Hey, by the way, I'm talking about entry tax planning. Of course, we also have it for business owner or self-employed people. You can do it yourself, and you avoid paying 10,000, 5,000, 3,000 to conduct an inclusive and comprehensive tax planning for you. So, I don't know if we still have more questions. If you don't have more questions, I'm going to thank you guys from Facebook, because I'm going to stop on Facebook right here before I even take the question. Yes, because this webinar is normally for the people who have the link to join. That's the reason why I said if you want to participate, use the link. But if you just want to watch it, go to Facebook. Very soon it will be broadcasted on YouTube as well. Go ahead and watch it. If you want to participate, use the link. I'm going to stop the Facebook on the Facebook page, and I really thank you guys on Facebook, and see you next week for another one.